Federal Reserve Chairman Alan Greenspan was on Capitol Hill today to talk about the U.S. economic outlook. He testified before the Joint Economic Committee. This is about an hour and a half.
Good morning. I'm pleased to welcome Chairman Greenspan to testify before the Joint Economic Committee this morning. We appreciate your appearance here today, Mr. Chairman, to discuss the monetary policy and the improved economic situation that has emerged in recent months. The economy appears to be recovering from the slowdown that began in the middle of 2000 and turned into a mild recession in March of 2001. The September 11th terrorist attacks inflicted further economic damage. Nevertheless, in the last quarter of 2001, real GDP increased 1.7%, with personal consumption spending surging at a 6.1% rate. In addition, manufacturing output has stabilized and appears to be expanding. Home sales have held up well, and large payroll employment declines have subsided. The liquidation of inventories last year has established the basis for inventory rebuilding later in 2002. Another positive aspect of the current outlook is that good productivity growth has been sustained through the business cycle and appears likely in the future. Economic forecasts generally anticipate a strengthening of economic growth during 2002. Leading market price indicators show no significant threat of inflation in the pipeline. The recovery has begun, but there are potential weaknesses and vulnerabilities that could affect the breadth and sustainability of the economic rebound. As the Federal Reserve has pointed out, the declines in business profits and investments were important factors in the recession, and these remain problematic. Despite the improvement in fourth quarter GDP, investment spending fell sharply. Business and household debt levels are relatively high by historic standards and could restrain growth. In addition, the weakness in the economies of some of our international trading partners limits overseas markets for U.S. production. Meanwhile, costs imposed by terrorism, the instability in the Middle East, and the increase in oil prices provide other potential impediments to faster U.S. growth. Unfortunately, there are a number of major risks to U.S. economic recovery. Given these risks, the current stance of the Federal Reserve monetary policy seems quite appropriate. The Federal Reserve wisely has shown restraint in not tightening monetary policy as the economic rebound consolidates. With little threat of inflation, there has been no reason for a tightening of monetary policy by the Federal Reserve. Mr. Chairman, before we turn the floor over to you, let me just say that unfortunately there are votes apparently scheduled in the Senate, and so our brethren from the Senate are not here yet. We expect them to arrive at the conclusion of their votes. And in addition, the members of the House are scattered here and there, and they will be along as well. I would also just like to ask unanimous consent that Congressman Sherwood, who is not a member of this panel, be invited and permitted to sit at the desk. Mr. Chairman, thank you again for being with us. We always appreciate your appearance here before the Joint Economic Committee, and of course today is no exception. The floor is yours, sir. We are ready to hear your testimony.
Well, thank you very much, Mr. Chairman. I, as always, appreciate the opportunity to appear here to discuss the current state of the economy. This morning, I'm speaking for myself and not necessarily for the Federal Open Market Committee. I'm also excerpting from a rather extended prepared testimony and request that the full text be included for the record.
Without objection.
Mr. Chairman, as we noted in our statement following the Federal Open Market Committee meeting in March, quote, the economy, bolstered by a marked swing in inventory investment, is expanding at a significant pace. Nonetheless, the degree of strengthening and final demand over coming quarters, an essential element in sustained economic expansion, is still uncertain. close quote. Mr. Chairman, little, if anything, has happened since the FOMC meeting to alter that assessment. This morning, I'd like to elaborate on some of the forces that are likely to shape activity in the months ahead. A number of cross-currents are likely to influence household spending this year. Through much of last year's slowdown, housing and consumption spending held up well and proved to be a major stabilizing force. But because there was little retrenchment during the cyclical downturn, the potential for a significant acceleration in activity in the household sector is likely to be more limited than in past business cycles. One important source of support to household spending late last year, energy prices, will likely be less favorable in the months ahead. With the rise in the world price of crude oil since the middle of January, higher energy costs are again sapping the purchasing power of households. To the extent that the increase in energy prices is limited in dimension, with prices not materially exceeding the trading range of recent weeks, the negative effects on spending in the aggregate should prove to be small. However, a price hike that drove oil prices well above existing levels for an appreciable period of time would likely have far more reaching consequences. Another factor likely to damp the growth of consumer spending in the period ahead, at least to some extent, is the change in overall household financial positions over the past 2 years. Household wealth relative to income has dropped from a peak multiple of about 6.3 at the end of 1999 to around 5.3 currently. About 9/10 of the decline in the personal saving rate from 1995 to 1999 can be attributed to the rise in the ratio of wealth to income, and the subsequent decline in that ratio is doubtless restraining the growth of consumption. Much of the movement in household net worth in recent years has been driven by changes on the asset side of the household balance sheet, but household liabilities have generally moved higher as well. Accordingly, the aggregate household debt service burden, defined as the ratio of households' required debt payments to their disposable personal income, rose considerably in recent years, returning last year to close to its previous cyclical peak of the mid-1980s, where it has remained. Neither wealth nor the burden of debt is distributed evenly across households. For example, increased debt burdens appear disproportionately attributable to higher income households. Although high-income households should not experience much strain in meeting their debt service obligations, others might. Indeed, repayment difficulties have already increased, particularly in the subprime markets for consumer loans and mortgages. Delinquency rates may well worsen as a delayed result of the strains on household finances over the past 2 years. Large erosions, however, do not seem likely, and the overall levels of debt and repayment delinquencies do not, as of now, appear to pose a major impediment to a moderate expansion of consumption spending going forward. Although the macroeconomic effects of debt burdens may be limited, we have already observed significant spending restraint among the top fifth of income earners, who accounted for around 44% of total after-tax household income last year, presumably owing to the drop in equity prices on net over the past 2 years. The effect of the stock market on other household spending has been less evident. Perhaps most central to the outlook for consumer spending will be developments in the labor market, which has improved some in recent months. The pace of layoffs quickened last fall, especially after September the 11th, and the unemployment rate rose sharply. But layoffs have diminished noticeably in 2002, and payrolls grew again in March. In typical cyclical fashion, the unemployment rate has lagged the pickup in demand somewhat, but it has remained between 5.5% and 5.75% of late, after rising rapidly in 2001. Over the long haul, incomes and spending are driven most importantly by the behavior of labor productivity. And here the most recent readings have been very encouraging. Output per hour continued to grow last year. Indeed, it rose at an annual rate of 5.5% in the fourth quarter of last year, and appears to have posted another sharp advance in the first quarter. No doubt some of the recent acceleration reflects normal statistical noise. More fundamentally, however, some of this pickup probably occurred because businesses have remained cautious about boosting labor input in response to the surprising strength of demand in recent months. But the magnitude of the gains in productivity over the past year provides further evidence of improvement in the underlying pace of structural labor productivity. In housing markets, low mortgage interest rates and favorable weather have provided considerable support to home building in recent months. Moreover, attractive mortgage rates have bolstered the sales of existing homes and the extraction of capital gains embedded in home equity that those sales engender. Low rates have also encouraged households to take on larger mortgages when refinancing their homes. The ongoing strength in the housing market has raised concerns about the possible emergence of a bubble in home prices. However, the analogy often made to the building and bursting of a stock price bubble is imperfect. First, unlike in the stock market, sales in the real estate market incur substantial transactions costs, and when most homes are sold, the seller must physically move out. Doing so often entails significant financial and emotional costs and is an obvious impediment to stimulating a bubble through speculative trading in homes. Thus, while stock market turnover is more than 100% annually, the turnover of home ownership is less than 10% annually, scarcely tinder for speculative conflagration. Second, arbitrage opportunities are much more limited in housing markets than in securities markets. A home in Portland, Oregon is not a close substitute for a home in Portland, Maine, and the national housing market is better understood as a collection of small local housing markets. Even if a bubble were to develop in a local market, it would not necessarily have implications for the nation as a whole. These factors do not mean that bubbles cannot develop in housing markets and that home prices cannot decline. Indeed, home prices fell significantly in several parts of the country in the early 1990s. But because the turnover of homes is so much smaller than that of stocks, and because the underlying demand for living space tends to be revised very gradually, the speed and magnitude of price rises and declines often observed in markets for securities are more difficult to create in markets for homes. Technological advances contributing to the gains in productivity that we have achieved over the past year should provide support not only to the household sector, but also to the business sector through a recovery in corporate profits and capital investment. The retrenchment in capital spending over the past year and a half was central to the sharp slowing in overall activity. These cutbacks in capital spending interacted with and were reinforced by falling profits and equity prices. Indeed, a striking feature of the current cyclical episode, relative to many earlier ones, has been the virtual absence of pricing power across much of American business, as increasing globalization and deregulation have enhanced competition. Part of the reduction in pricing power observed in this cycle should be reversed, as firming demand enables businesses to take back large price discounts. Though such an adjustment would tend to elevate price levels, underlying inflationary cost pressures should remain contained. A lack of pressures in labor markets and increases in productivity are holding labor costs in check, resulting in rising profit margins even with inflation remaining low. To be sure, over time, the current accommodative stance of monetary policy is not likely to be consistent with maintaining price stability. But prospects for low inflation and inflation expectations in the period ahead mean that the Federal Reserve should have ample opportunity to adjust policy to keep inflation pressures contained once sustained, solid economic expansion is in view. Improved margins over time and more assured prospects for rising final demand would likely be accompanied by a decline in risk premiums from their current elevated levels toward a more normal range. With real rates of return on high-tech equipment still attractive, the lowering of risk premiums should be an additional spur to new investment. Recent evidence suggests that a recovery in at least some forms of high-tech investment is underway, but the pickup this year in overall spending on business fixed investment is likely to be gradual. The U.S. economy has displayed a remarkable resilience over the past 6 months in the face of some very significant adverse shocks. But the strength of the economic expansion that is underway remains to be clarified. Some of the forces that have weighed heavily on the economy over the past year or so have begun to dissipate, but other factors, such as the sharp increase in world oil prices, have arisen that pose new challenges. As a result, the course of final demand will need to be monitored closely. Still, there can be little doubt that prospects have brightened. Spending in the household sector has held up well, and some signs of improvement are evident in business profits and investment. Fiscal policy continues to provide stimulus to aggregate demand, and monetary policy is currently accommodative. With the growth of productivity well maintained and inflation pressures largely absent, the foundation for economic expansion has been laid. Thank you very much, Mr. Chairman. I look forward to your questions.
Well, Mr. Chairman, thank you very much for the very articulate statement that we have come to expect when you visit with us. We appreciate it very much. It seems to me, Mr. Chairman, that in recent months there have been many signs that the economic recession that began last March has ended. For example, in the fourth quarter of 2001, growth was positive. The manufacturing sector seems to have bottomed out, and large payroll employment declines seem to have subsided. So looking at those factors, it would seem to me that the future looks bright. At the same time, you mentioned in your statement that there are continuing problems or potential problems looming on the horizon, and some that are already with us. You talked about the accumulation of debt, the consumption rebound that took place in the last quarter of last year was quite remarkable, and we're glad that it happened, but it takes away some of the consumption rebound potential for the current period and perhaps for the period ahead. The investment rebound has not occurred as strongly as we could have hoped. Energy prices continue to be a worry. International sluggishness in some of our trading partners, particularly Japan and Central and South America, is evident, and the costs associated with terrorism continue to be and will continue to be a drag on the economy. So I guess my question is, how do we balance what is the balance, or how do we balance the good with the potential negative factors that we have all talked about here in the last month or so?
Mr. Chairman, this is a very important question, because one aspect of the dilemma that you raise is the remarkable and unusual divergence between the economic outlook as evaluated by economists on the one hand and a significant part of the business community on the other. As you know, the latter are showing far less optimism about what is apparently going on than those of us who are evaluating the gross domestic product, the more larger aspect of the economy. And what we are observing, obviously, is that retail sales, consumption generally is holding up, home building is holding up, and we are seeing a very significant swing from inventory liquidation ultimately to either some degree of small accumulation or at least inventory balance. What this does is it creates a really quite different view of the economy depending on where you're looking at it from. We add up the so-called net consolidated sales of the economy, which is, I should say, net consolidated production of the economy, which is essentially what the gross domestic product is. But from the business point of view, what they see is a low level of sales, because remember, a goodly part of consumption is coming out of inventory, and a significant decline in profit margins and virtually no pricing power. So from that point of view, the lower end of the economy, if you want to put it that way, where the business sector largely is functioning, you're getting a continued degree of weakness. Obviously, you cannot have this process going on indefinitely. Either we are going to get a significant increase in production, in profits, in capital investment, which is what our forecast is, and what the data, as far as we can judge, seem to portend, or we're going to get real slip back, in which case production will not move materially, nor will profits or investment. This is an issue which will be resolved within the next 2 to 4 months. The odds are very strongly in favor of it being resolved in continued economic growth, resumption of profitability and capital investment. But clearly there are concerns out there, and there are risks. And you mentioned a few of them, and I think quite correctly.
Mr. Chairman, in your statement, you referred to monetary policy, and in the same sentence, or in the context of that, you said that sustained solid economic that monetary policy might be adjusted, I guess you said, when sustained solid economic expansion is in view. You have said here that we have laid the basis or the foundation for economic growth, but you haven't said that sustained solid economic expansion is in view. Is that correct?
It's not sufficiently in view to be comfortable with the outlook. As I indicated in the testimony before the Senate and the House a month ago, what we are aware of is a very strong recovery currently underway as a consequence of the dramatic reduction in the degree of inventory liquidation. But the crucial issue, which I repeat in my testimony today, is whether so-called final demand, which has been growing very modestly, continues to grow and indeed accelerates after, or I might say before, the very strong impetus coming from the swing in inventories dissipates. We're nowhere near a judgment of that as yet, and cannot be. I mean, we haven't yet gotten to the point in the cycle where we know exactly how that is resolving. But my impression is that as the quarters go on, things will become obviously very clear in retrospect, but hopefully we'll be able to get a reasonably good judgment of what's happening sufficiently in advance. But as I also point out in the sentence to which you refer, we are very fortunate in that there is little, if no evidence, of inflationary pressures building. And that means that the urgency of responding to economic events is less than it would be were we dealing with the other possibility.
You anticipated my next question in your response on your statement on inflation. So let me move to one other subject that I feel it's very interesting, and then we'll go to Mr. Reed. One of the most positive aspects of economic growth over the last period of time, over the last 5 years, is based on strong productivity performance. And this was something that I hadn't fully understand and maybe still don't, but this productivity trend was rooted in earlier technological innovation and investments in people and equipment, as well as improved production methods. The Fed's recent monetary policy report to Congress noted, and I quote, that productivity was impressive. Does it appear that strong productivity growth in recent years has been carried through the business cycle? Do we still see strong productivity? And does this strong productivity performance increase the ability of the economy to continue to grow without inflation?
It does, Mr. Chairman. One aspect to an evaluation of the effect of the dramatic changes in technology that occurred in application in the second half of the 1990s was the fact that numbers clearly showed growth in output per hour far exceeding those which we had experienced generally in the previous quarter century. And the question that we had was how much of that was merely a cyclical phenomenon, because productivity is pro-cyclical. We wouldn't know until we ran into some cyclical downturn. We have done that, and if anything, the results are far more impressive than we would have expected. As I indicated in my prepared remarks, I think some of the numbers we're looking at are statistical noise, meaning it's just the fact that these are very difficult numbers to measure. But even extracting from that, even making all the adjustments you want, it's an extraordinary performance, which I must say bodes well for the longer-term outlook of this economy.
Well, thank you. That certainly sounds like good news, and we look forward to watching this factor as we move forward. And
I just wanted to say I just don't believe that we can continue the numbers that will be published for the fourth quarter and the first quarter indefinitely. The world does not work that well.
Yes, sir. Thank you very much. Senator Reed, we're glad your votes are subsided for the moment, and the floor is yours.
Thank you very much, Mr. Chairman, and thank you for calling this hearing. I have a statement which I would like to include in the record with your permission.
Without objection.
Thank you, Chairman Greenspan, for your testimony today, and also for you and your colleagues' very adroit use of monetary policy over the last several months to keep us moving forward. Let me begin with a question. A year ago, Mr. Chairman, you worried that we might be in danger of paying down the national debt too quickly. You suggested we might have to find ways to reduce the surplus, and many people took this as an endorsement of the President's tax cut. Do you still have that concern?
No, if you may recall, Senator, the concern I had stemmed from the Congressional Budget Office's long-term projection of the current services budget, which exhibited a pattern of growing surpluses, which would imply that by 2006, that the federal government would start to have to accumulate private or state and local assets because it could no longer run down the debt. In other words, no longer employ the surplus as debt repayment. In fact, the number that they showed was, as I recall, $500 billion annual surplus. I had indicated that I thought that accumulation of private assets by the federal government was a very undesirable economic policy for a lot of reasons. If I held that position, which I still do, and we are looking at the data which they published, then the question was, how did you get the $500 billion surplus down to zero to prevent the accumulation of assets? And the answer is, no matter how you do it, it would be an extraordinary expansion of fiscal policy. It would be huge stimulus, which may be wholly inappropriate for that particular time. So I argued that either expenditures ought to be increased or taxes ought to be cut. I preferred tax cuts, and indeed, the bills before the Congress at that time, either one of them, by the president's or the congressional bills, both were adequate to solve the problem of eliminating the surplus by the mid-decade. And indeed, we got a significant tax cut, and the problem was solved. So I'm no longer concerned about it.
Might this significant tax cut cause other problems? As you noted, the projections were about over $5 trillion of surplus over 10 years, and now these projections have dropped to about $1.7 trillion in less than a year, or just about a year. That's a $4 trillion reduction. And in fact, the President's recent budgetary proposal would further reduce this projected surplus to less than $500 billion. But are we in danger of running into some of the same problems we've seen before, which is we run deficits, we put pressure on interest rates, we get back into the fiscal difficulties we had in the 80s and the 90s, particularly now since so much of what we must spend money on is non-avoidable, the war on terrorism and other major programs?
No, I think that we have to be very careful about going back into deficit spending, which is very easy to do. And the reason largely, obviously, is that the evidence does indicate that if you start to run substantial deficits, you will begin to move long-term interest rates, and the effect of that on the economy is clearly not favorable. My judgment is that we have got to come up with a much longer-term focus on fiscal policy. As you know, we have a very major demographic shift that occurs at the end of the decade. I think what we have to do is to decide where we want to be in the year, say, 2013 or something of that, somewhere in that area, with respect to the level of debt, the policies of both the unified budget, but also what I would call the accrued budget, which includes the contingent liabilities of the federal government. And then, in a sense, having decided where it is sustainable over the longer run, given our demographic changes, work back towards what type of path would be desirable to have in fiscal policy. And my judgment is that it's very unlikely that a very large protracted deficit for the rest of this decade would be where one would want to come out.
Mr. Chairman, we have seen over the last several weeks and months some encouraging signs about the economy, but one area of continuing concern is the unemployment numbers, which are still hovering around 5.4, 5.8%. And there's a possibility that as other factors of the economy improve, we could be in a situation where unemployment lingers at these levels. And are you concerned about a jobless recovery, one in which other indexes will show progress, but unemployment will remain at high levels?
I'm not, Senator. I think that what we've observed currently is a significant recovery underway in the context of very strong gains in output per hour. And the data show not only a rise in output, but a decline in hours total, and a decline in employment, which is even more because, as you probably are aware, overtime has gone up and the average weekly hours have gone up. So what we are observing at this particular stage is the consequence of the economy recovering in the context of very strong productivity growth, which is very favorable. But what we also were able to observe in the latter part of the 1990s was that this very productivity growth enabled the unemployment rate to be driven down quite significantly without any inflationary implications. And if that pattern is still there, it essentially says that that's likely what will happen eventually in the future. So I'm not concerned about chronically elevated levels of unemployment. I think that as this recovery takes hold, that those levels will come down, as indeed they did during the latter part of the 1990s.
Thank you. One final question, if I may, Mr. Chairman. You argue very eloquently for a longer-term perspective in which we will take into consideration not just the combined consolidated budget, but our contingent responsibilities, particularly with an aging population. And in that context, calls to make the present tax cuts permanent would seem to me to complicate further the resolution of these contingent liabilities particularly. What is your feeling about making permanent the current temporary or at least
well, Senator,
mandatory tax cuts?
I can't talk about the politics of this because clearly the issue from an economic point of view is somewhat different. I don't know of any economist who does long-term forecasting and presumes that the tax cuts will fall off the cliff at the end of the period in which they are statutorily in place. So my own impression is that the markets assume that those tax cuts are permanent. In other words, the legal question is a political issue. I don't think it's an economic issue because I don't know anyone who seriously believes that the world works the way the legislation stipulated.
But that leaves us with, if you believe that, with even, I would suspect, a greater deficits potential in the future.
Yes, that's correct.
Which further complicates the tough problems we have right now.
I would agree with that. I think that were I doing a forecast for the long-term unified and what I call a crude budget, I would not make the presumption that the Congress at that particular point is going to act to rescind those taxes in the way the statute now stipulates.
Thank you very much, Mr. Chairman. Thank you, Chairman.
Thank you, Senator Reid. We're going to go to Mr. Smith, but before I do, if I just may follow up, Senator Reid, I think, appropriately raised the question of deficit and surplus. Isn't the economic slowdown a major reason for the shift in the 2002 fiscal situation?
It certainly is, Mr. Chairman.
Thank you. Mr. Smith.
Mr. Chairman, thank you for holding this hearing, and Chairman Greenspan, thank you for being willing to testify. My first question goes to the Patent and Trademark Office, and in particular the amount of time required to have a patent approved when requested by businesses today. The average time, as I understand it, is about 2 years, and the length of time required for patent pendency is expected to increase rather than diminish. And it seems to me this is a real disadvantage to high-tech companies who oftentimes produce a product quickly, develop it quickly, and oftentimes the product has a short shelf life. I wanted to ask you if you felt that the length of time required to have a patent approved is a disadvantage to high-tech companies in particular and harmful to the economy in general.
Yeah, Congressman, I think you're raising a very important question, but it goes beyond patents. It goes into the regulatory patent, I should put it this way, it goes into the whole structure of the interface of how government regulates in a wide variety of areas, including the time it takes to do a lot of things. Since it's evident that one aspect of the economy that has emerged in the last 6 or 7 years is a very quickened pace of response, as information technology has created a tremendous amount of real-time information systems. All adjustments are happening far more quickly, including the life cycle of a particular innovation, which is the issue that you're raising. And I'm fearful that the tendency to just apply the same old time lags in everything we do is contrary to the new economy, if one wants to use that term, which I hesitate to use, but it's useful in this context.
Would your comments also apply to depreciation schedules for technology products like computers?
I don't think so, because I think those are indeed being adjusted to the proper periodicity and degree of obsolescence. That is handled automatically, or it should be. I mean, obviously, to the extent that there are delays in IRS certification of various different types of programs, clearly that would be an issue. But I'm not aware that that is a problem at this point.
Specifically in regard to that last, the depreciation schedule, for instance, for a computer is now 5 years, and it seems to me, given what you just said about technology, that that's a little too long. We all know that computers are usually out of date within a year or two. And I think, I wanted to ask you as well, if you think that those depreciation schedules should be adjusted.
I really can't say, because I do know that there's a continuous reevaluation of so-called economic life, which is what you're raising, versus, say, IRS or even FASB issues with respect to depreciation charges. I think everyone is aware that this issue is out there and it's being addressed. I don't think that's where a major problem is. I'm more concerned about the issues you raise with respect to patents and the long time it takes, for example, to get new pharmacological innovations through FDA as well. I mean, these are very tough issues because clearly you don't want to run through a patent evaluation and find that there's truly patent infringement involved, and it takes time to make a judgment as to whether the patent is an innovation in true one, and obviously it takes time to examine new drugs. So I'm not arguing that we should push it merely for the sake of pushing, but I think we ought to be aware of the fact that that process is negative to innovation.
Thank you. Chairman Greenspan, one last question. You refer in your testimony to the technological advances contributing to the gains in productivity. One of the most astounding figures I've read recently is that I think 2/3 of our economy's increase in productivity gains since 1995 are attributed to information technology. And I wanted to ask you if you think those contributions to the economy by the information technology sector will continue, and if they're as important in the future as they have been in the past?
Well, it's difficult to make a judgment of what part of the increase in measured output per hour, which we do reasonably well, even with all the statistical noise that's involved in the process. It's difficult to make a judgment of exactly what proportion of that change is attributable specifically to information technology per se. We can make reasonable judgments as to what part is attributable to aggregate capital investment input, labor input, and what we call overall multi-factor productivity, which is a measure of the conceptual improvements that have existed. But most people are coming out close to the number which you suggest with respect to information technology. And as best we can judge, the overall networking effect and all of the various other aspects which relate to information technology and the broader computer technologies which are associated with it have only partially been exploited. Indeed, as I indicate in my prepared remarks, when you go out and survey purchasing managers or indeed corporate executives more generally, you'll find that they all perceive that there's very significant amount of as yet unexploited profits in investments in information technology and in other high-tech areas as well. So there is no evidence of which I'm aware which suggests that this big surge in technology, which really starts with, as far as applications are concerned, in, say, 1994, 95, there's no evidence that that is petering out. Indeed, the productivity numbers which we've observed for the last 6 months are very strongly supportive of the notion that there's a lot out there yet to mine.
Thank you, Chairman Greenspan. Thank you, Mr. Chairman.
This subject of productivity I find very fascinating because it seems to me that as we increase workers' productivity, it would tend to have the effect of taking pressure off increased labor costs, which would have the effect in turn of taking away certain inflationary pressures. And so this seems to me to be a very important factor in what we've seen over the last decade or two.
I agree with that, Mr. Chairman.
Senator Corzine.
Thank you, Chairman Saxon, and appreciate your holding this hearing. It's always great to get the insights of the chairman of the Federal Reserve, who's done such an outstanding job in his tenure. I would like to maybe go back over some of the ground that Senator Reid brought up with a little different angle. There's certainly a political debate about whether we should make permanent the tax cut. Matter of fact, very strong arguments from the economic side of the House of the administration and others that the current recovery is being hindered because of the sunsetting of the legislation. I take it from your response to Senator Reid, you probably would not believe that anyone is really factoring in that these tax cuts wouldn't be made permanent.
Well, obviously, if they did, then in effect, the presumption, well, let me go take a step back. Every analysis of a corporate investment, as you know, endeavors to project out cash flows into the future off the investment, and part of that analysis is the tax rate you apply. My impression at this particular stage is that most people presume that the tax cut is permanent and that the tax rates will remain as they are postulated in current law. If you rescind them, the implication is for that project, the cash flow rate of return, as you know, would go down, so that the argument really gets down to whether companies making investments have effectively assumed that those tax cuts will be permanent or not. If they assume that they will be permanent and they turn out not to be, then clearly that would have a negative effect.
But at least at the moment, it is not your assumption and how you're looking at the economy that people are assuming that.
My general impression is that most business investment going forward is making the judgment that those tax cuts are indeed permanent.
Okay. Let me also reiterate, if that is in fact the case, those tax cuts are permanent. Have you or your staff done analysis of what the cost of that tax cut would be in the second 10 years after 2011, and does that really drive at the question of fiscal policy in the context of this long-run demographic challenge that we have as a society?
Senator, we have not. So the only longer-term projections we make are in the Social Security area for purposes of trying to get some sense of what the contingent liabilities are and therefore what the contingent debt obligations of the federal government is. I don't think that we go much beyond the next 2 or 3 years ourselves. We rely to a very substantial extent on estimates by CBO and OMB on the grounds that those are very difficult calculations, as you know as well as I, and they have much greater insight into the detail and, I hope, better models than we. So we tend to use their data as a base from which we function.
I believe that the estimates that I've seen from those models are an additional $4 trillion of revenue declines in the second decade after 2011. And it is a concern on how our fiscal path will be as we approach that and the demographic bubble at the same time with regard to both Medicare and Social Security. I presume I'm reading that you're concerned about that coming together of similar issues.
I am, Senator.
Thank you.
Senator, thank you very much. Mr. Chairman, couldn't increased uncertainty about future tax policy, couldn't it undermine economic and business decisions that might produce and have a result of producing a drag on the economy?
Well, Senator, I'm sorry, Mr. Chairman, I think that tax policy is a crucial aspect of what the longer term is all about. And I've always argued that we probably would do better with lower corporate tax rates and as a general rule. And I've argued that the capital gains tax rate has not been a particularly productive vehicle for raising revenue, because these are both charges against capital accumulation, which is such a crucial aspect of the gains in productivity and economic growth which we have just been talking about. So I don't, it's a very complex subject, as you know far better than I, having been dealing with it up here for many years. I have nothing really much to add to the discussion.
Thank you very much. Ms. Dunn?
Thank you very much, Mr. Chairman. Welcome, Mr. Chairman. I wanted to continue that discussion about tax relief just with a couple of questions. You suggested that most economists and the business community are banking on the tax relief being a permanent change, which pleases me. I like to hear that because I think that adds momentum to our effort to make sure that is
Congressman,
done.
I should just say that's my impression. I've never done an actual study, but I've spoken to a lot of people, and that's my general expectation.
And I'm happy to hear that. There are some areas, though, that unless we make them permanent very quickly, I think will result in no behavioral change. And I bring to your mind the death tax repeal, that if it is not made permanent, I don't see why anybody would have any incentive to change behavior, how they spend money on estate planners and life insurance to provide for an unpredictable event. What's your thought on what we ought to be doing here with regard to permanency? Ought we to be doing this earlier, or maybe we can get Senator Corzine's vote now that you've spoken here, but what's your thought on how this should move?
Well, whatever you do, Congresswoman, I think it has to be clear where the longer-term tax structure in this area is. You cannot do estate planning, as you point out, unless you have a judgment as to what these numbers are. And wherever the Congress comes out, I think it's far more important that it come out clearly and unequivocally and not have an issue pending as to an issue which would create a degree of uncertainty which would make estate planning very difficult to implement.
Yes, thank you. Are you an advocate, or are you a believer in the idea of the tax relief providing a bridge during recessionary times for typical folks at home?
I'm sorry, I didn't quite get that.
Larry Lindsay has talked in terms of tax relief providing a bridge for people to get through a time of recession. They'll have more dollars in their pockets because of tax relief. Are you a believer in that theory?
Well, he's basically raising the issue of using tax policy as a fiscal policy, which is sort of a standard economic procedures. It goes back many generations. I mean, the issue of counter-cyclical fiscal policy in many respects had the tax lever as a crucial element in that.
And you do believe that?
Yes, I do.
Okay. We have a big problem with unemployment in the Pacific Northwest. Oregon and Washington, for example, continually lag 2 or 3% behind what's happening in the rest of the nation. And many of the jobs that have been lost, and you'll recall the layoffs that are occurring right now, 30,000 layoffs in the Boeing company alone from their commercial line. Now that businesses are slowing the pace of inventory liquidation, do you think that this signals that companies will begin making products again and therefore begin to hire workers back?
Well, I certainly think that as the expansion takes hold, the answer is very clearly yes. With respect to essentially Boeing and Airbus, the two major players in the world on new commercial aircraft deliveries, the sharp fall off in demand for airline travel, especially business travel, as you know, is still creating problems for airlines, and Boeing schedules are reflecting that. And indeed, I would suspect that until we see a restoration of business airline travel for business and a reestablishment of profitability in the airlines, is going to be quite significant restraint on capital investment for new equipment. And indeed, I make the point in my prepared remarks. So it's quite conceivable that the pattern of airline revenue and new orders for equipment will take a somewhat different path than overall, because that is a special case, very significantly impacted by the events of September the 11th and thereafter. Whereas the rest of the economy is in a somewhat different mode with respect to the issue of terrorism and concerns about it. So over the longer run, there's no doubt in my mind, as I answered earlier, that the unemployment rates will be coming down in general, And the one thing one can say about the American economy is that it is really far more a single economy than it has been at any time in my recollection. All aspects of this economy, I should put it this way, there are not the significant geographic differences that we used to experience 3, 4, and 5 decades ago. I mean, very recently, we're finding that when we survey all of various different industries and various regions of the country, it is remarkable throughout, say, 2001, they behaved very much in sync with one another. You could almost replicate the discussions in one area and in another with another, and that's still true to this day. And with the recovery coming back, we're seeing very much the same phenomenon, that everyone's moving together. So I should think that while there will be differences owing to industrial differences, and the Northwest is clearly a case, over the longer run, that is unlikely.
Good. Thank you.
Thank you very much, Ms. Dunn. Thank you for emphasizing the importance of the need to provide clarity with respect to the inheritance tax. I think that is an extremely important point. Mr. Sherwood.
Thank you, Chairman Saxon and Chairman Greenspan. It's always great to hear you. Thank you for coming. As I listened this morning, if I understand, I think you told us that retail sales are holding up well and home building is remarkably strong. But the key to the economy is productivity growth. The key that makes us being able to have a good economy without inflation. And as we hear so much about less manufacturing and more service industry in the economy, when we think of productivity, we think of productivity in manufacturing. But obviously, you must mean productivity in other sectors as well. Could you chat a little bit about that for us?
Productivity is obviously has been strongest in the manufacturing area. Our data indicate that non-manufacturing, the whole other area, is also showing significant increases, and there is even the possibility that the gap between manufacturing on the one hand and services and trade and other areas on the other may be more a measurement issue than we realize. In other words, it's very much more difficult to get the value added, which is the numerator of output per hour, in services than it is where you have a physical good where you can really see what's happening. And our price data are clearly suboptimal in making those types of calculations. But the numbers that I have been citing are the overall productivity. In fact, the general numbers that most people use are non-farm business sector productivity, which is a third manufacturing and about 2/3 non-manufacturing.
The other issue, you said that unemployment will come down, and I know that there have been a great deal of the growth and the strength in our economy has been the fact that we had workers available, non-citizen workers. And after 9/11, with us being much more careful of our borders and people having the proper identification for all the right reasons, is this liable to be a damper on the economy? Do you see that coming?
Congressman, it's a very difficult issue because clearly securing our borders is a crucial aspect in the war on terrorism. Nonetheless, we are dealing with a fact that a third of the increase in our labor force is coming from immigrants. And it's enabled us to have a rising number of households, which has been a major factor in why home building has been so powerful a force in the economy. So I think there is a very important trade-off question here, and it's one of the many issues which the war on terrorism has surfaced, and which have to be confronted by the Congress. There is no easy answer, because clearly the extent to which you enhance one aspect of the problem, you create potential difficulties for the other.
Thank you. You said we'll know in the next 2 to 4 months, if I understood you correctly, what direction certain things are going to take. And if I understood you, you said that a lot of the retail sales are coming now from reducing inventories. And so are you telling us that business will have to make a decision then whether to replace these inventories? I wasn't just sure I understood your 2 to 4 month.
Well, the point I was trying to make is that when you're dealing with a situation as we are today and have been since late last year, where production has been held down very dramatically by inventory liquidation. In other words, if you think in terms of consumption as being sort of a level up here and production representing being well below it, the difference between the two is obviously the amount of goods that are being supplied to consumption out of inventories as distinct from newly produced goods. But as the level of inventories goes down, clearly it can't go below zero, and so well before zero, it has to slow its rate of decline, which means that if consumption is stable, production must rise and supply more of the consumption than it did previously. And that's the process which we're now going through. As production continues to rise, and since consumption has been relatively stable, we are creating a higher level of demand for people, so that you're getting higher incomes, greater employment, more purchasing power, higher profits. And the question basically is whether all of those forces cause demand to kick in at a higher level when the initial thrust coming from the impetus of reduced inventory, the rate of inventory liquidation, finally dissipates. It's like a first stage rocket carrying you up to a certain point, and then a second stage rocket essentially carrying you further. We are in the first stage rocket, if I may put it, the analogy in that respect, but we're not yet at the point where its momentum is petered out enough where we can see significant changes. But what we will learn as the months evolve is whether the increased demand from the increased incomes and profits being created by the shift from inventory liquidation to zero change in inventory, whether that shift creates a demand for goods and services over and above what is currently in place to give us an accelerated pickup in final demand, as we put it. That's what our forecast is. That's what tends to be the case in our history. But until you actually see it, it's still probabilistic, and you're still not certain. As I say, there's a large degree of uncertainty with respect to this issue out there.
Thank you.
Thank you, Mr. Sherwood. Mr. Putnam.
Thank you, Mr. Chairman, and welcome, Mr. Greenspan. Over the course of the past 18 months or so, as we've come through this recession, the consumer and household spending and home mortgages and auto sales have essentially carried the day. The consequence of that, in fact, a Fed report referred to the frenzied refinancing of mortgages, but a consequence of that has been a rise in consumer or household debt. Is that a concern of yours, and what does that bode for future abilities or future room for growth in household spending?
We've examined that in some detail, Congressman, and we don't sense a serious problem at this stage. We don't expect it to get worse, but even now it's not a big problem. One of the reasons is that a goodly part of the increase in debt is mortgage debt. And mortgage debt, to a very substantial extent, is supported by the market value of houses. And indeed, despite the fact that there's been a very dramatic increase in mortgage debt, the equities within homes continues to rise. And this is especially the case for the lower 4/5 of household calibrated by income, because as I point out in my prepared remarks, a goodly part of the debt increase is in the upper quintile, which is almost a half of overall economic or actually overall consumption. So I would think that while we do see that the debt service levels, that is the amount of amortization plus interest as a ratio to income, is up at pretty high levels, there is a significant capability in most households, especially those which own homes with equity in them, to employ home equity loans, or in cases of refinancing, so-called refinancing cash outs, where you take out more cash, you take out cash out of the process. And what that enables a lot of households to do is pay down their installment debt, their credit card debt, and indeed have done so. Now, clearly there are segments of our society, however, which don't have large equity positions in homes, and we do see that in subprime lending, in both consumer and mortgage lending, that delinquencies have indeed gone up, and we're probably likely to see further erosion, because these types of things tend to lag behind the economy. Indeed, I should have mentioned earlier with respect to the discussion of unemployment, there's a tendency for unemployment itself to be a lagging indicator, which is clearly a factor in why you get delinquencies and difficulties in household debt carrying into the recovery period, into its early stages, because it takes time for that process to work its way through. But the bottom line is that having looked at this as best we can, we don't perceive it as a significant impediment to an expansion in consumer expenditures.
A private economist, a number of private economists have indicated, as has the government, that IRS refunds are up perhaps as high as 26% over last year. Does this give the consumer some additional breathing room, and will this have a stimulative effect as this economist from Goldman Sachs predicts a high level of tax refunds to increase personal income by as high as $3 billion a month?
Well, remember, those refunds are only up to a point, and then they fall off. It's hard to know what people expect with respect to refunds and when they spend them, but there's no question that they do have an effect. But clearly, as you get to April the 15th, and that begins to peter off, because a good deal of refunds obviously occur prior to the April 15th date, but some of them go beyond. So a goodly part of that is already in train.
Thank you very much, Mr. Chairman.
Mr. Chairman, we promised we'd finish this hearing in a timely fashion to try to accommodate your schedule. If you have time, sir, Mr. Corzine has one final question.
Mr. Chairman, we were talking earlier about certainty and clarity. And one of the things that I think we've talked about before in other hearings is change of circumstances should lead or often leads to change in policy considerations. Just as you suggested that if we were going to have a pay down of the debt and potential investment by governmental authorities, that would imply one policy versus one where deficits might impinge on the ability of the economy to save and have productive growth. It strikes me that we are not showing the flexibility in fiscal policy that I think I have heard you endorse with regard to changing circumstances it might be. We do have a war today, a war on terrorism that has changed our spending needs. And while there is a need for clarity with regard to tax policy, I presume there's a need for clarity with regard to spending on education, special education, or spending on cleaning up the environment, or spending with respect to, or at least building up of reserves or potential capacity to pay for our Medicare expenses in future years, or Social Security for that matter. So I'm curious whether you think we are showing enough flexibility with regard to our fiscal policy strategies, which certainly wouldn't reflect how the Federal Reserve has managed monetary policy over a few years. And clarity is a two-sided coin. It's not just with taxes. I would suppose it is also with the resources that come with expenditures. I'd love to hear your comments on that.
In principle, there's no question that we have to do it, and we have to try to do it as best we can. In practice, we have very considerable difficulty.
We have to have flexibility in our policies.
Yes. In practice, we have considerable difficulties, largely because our forecasting capabilities are not up as yet to the task. And one of the reasons is that if you're dealing, for example, with a $2 or $2.5 trillion budget, and you have receipts and outlays roughly the same, as you know, very small changes in the balance of these very large aggregates engender very significant swings in unified budget surpluses and deficits. And I think that, you know, the fan chart that CBO shows with respect to its probabilities is a good representation of what their history has been. And it's not that they're inadequate forecasters. They're pretty good as far as the profession is concerned, but it's an inherently very difficult exercise. And so I think as part of this flexibility question, you've got a very important question of making judgments of what the probabilities of various different outlooks are, and then making judgments. But that you have to do it, there is no question. That you have to be flexible because events are changing by their nature is no question. I just merely raised the issue of how good our capabilities are in implementing policy. Monetary policy is easy in that regard. We only have to make judgments, technically speaking, 20 minutes in advance before we can implement a policy. But you obviously cannot do that with fiscal policy. There are very long leads and lags and very long projections. And my impression is we probably would be wise to spend more time thinking about this problem, because it's going to become a very serious issue as the years go on, if for no other reason than one of the easiest things to forecast is the demographics which are going to hit us. And I don't get the impression that we yet have the technical capability to come at this in a manner which is as effective as I think we're going to eventually need.
Would you just comment also, though, on the clarity of expenditures and investments in education, et cetera, in
well, I think
contrast or at least in comparison to clarity with regard to tax policy?
I'm sorry, clarity to tax policy, you say? Well, I don't know what, I mean, clarity to me means basically you have a long-term strategy, you know where you're going, and you have a policy of getting there. And I think one of the interesting issues that the Congress has to confront is trying to make judgments as to, say, for example, in education policy, which policies work and which don't. And so there's a diagnosis of the problem which I think is still in very significant debate within the society. And until we come to a conclusion of what works and what doesn't work, it's hard to get a fiscal policy which embodies that. So I think there's important issues here of a conceptual nature which I think have got to be resolved. I think over the years we've had many such arguments, and we've to a greater or lesser extent resolved them. And I think that's probably one of the things which is the major strength of this country.
Thank you.
Mr. Chairman, thank you. Mr. Chairman, you just made reference to fiscal and monetary policy and its effect on influencing economic growth. How effective were the implementation of fiscal and monetary policy in 2001 in offsetting the recession, in your opinion?
In the most recent period?
Yes.
Well, I think both worked probably better than they usually work. That is, of necessity, all policy implies a forecast. We like to pretend that these are mechanical procedures which one can be implemented without making forecasts, but that's not factually the way the world works. And I think for better or worse, the timing of policies have largely been, in my judgment, reasonably good in this respect.
How well timed were the policy movements in 2001?
With respect to, I mean, how was it in 2001? I thought that both tax and monetary policy turned out to be reasonably well calibrated.
Thank you. One final question with regard to forecasting inflation. It doesn't appear that, at least from the statistical evidence that we have available, that there's any real problem with inflation currently, nor does it appear that there's a problem in the foreseeable future. But given the current economic situation, what indicators in the coming months would tend to be the most helpful in evaluating risks of future inflation?
Well, all of the analysis that we make from the point of view of a central bank is to endeavor to make those judgments. I think that you don't look at any individual indicator because that doesn't really help you because it keeps changing. You try to understand the process. You try to understand what are the broad forces, both domestically and globally, which are making the economy move. One aspect of that analysis is an evaluation of potentially building inflationary pressures. So I would not say that there's a single statistic which would tell us that sufficiently in advance. Obviously, the price indexes themselves are what we're measuring, but they are very lagging indicators. And you can't really make useful judgments looking in the rearview mirror, if I may put it that way.
Thank you very much. Senator Bennett has arrived, Mr. Chairman, with your, the chairman is on a kind of a tight leash, Senator, so we welcome your questions, but hope you'll keep that in mind.
Thank you very much. I'll try to abide by that admonition. Mr. Chairman, It's been pointed out to me, at least one body of opinion, rather than necessarily casting it as a fact, but one body of opinion is that since the dollar is now the de facto reserve currency of the world, if not the dominant currency in the world, you are not only the central bank for the United States, you become the central banker for the rest of the world. And I know you didn't sign up for that, but there are many people who give you that particular responsibility. I would like to get your views on the question of world liquidity. Many people say Japan is in a serious deflation. There's a liquidity crisis in Europe. And that while we may have statistically enough liquidity in the economy in the United States, on a worldwide basis there is a liquidity problem, and that somehow you have to be involved in that. And while you're pondering that one, I'll pose the second somewhat related question. As we come out of this recession, we must face the reality of world overcapacity in a number of industries. Steel is the most obvious, but there are a number of industries where there's a significant overcapacity, and of course overcapacity tends to dampen economic recovery when you're coming out of a recession circumstance. So could you address those two related questions, and the amount of money available in the rest of the world and the impact of that on our economy, and then the amount of overcapacity in the rest of the world?
Senator, I'm not concerned about the issue of world liquidity, largely because to a very substantial extent, the system creates liquidity as is necessary. The central banks of the world obviously are crucial at the ultimate level of liquidity creation. And here one finds very little evidence that there's any particular problem. I mean, you can look at the European community, there's certainly no difficulty from liquidity point of view. I trust there's none in the United States, nor do I perceive one in Japan, for example, or elsewhere. One of the reasons is that markets work to create...
If I could just... Japan is in a deflation, from your view, is it not?
Well, Japan is beginning to show signs of stabilization as a consequence of the fact that the United States and Europe are beginning to firm. So, to be sure, there has been a very serious deflationary problem in Japan, but there are the first inklings that that is beginning to stabilize. I don't wish to say that they don't have significant problems, which they clearly do, but I wouldn't perceive this as a particularly major issue if the rest of the world is beginning to move. On the issue of overcapacity, that's a problem, Senator, which I think we always have, one way or the other. And clearly, steel has become the poster child of overcapacity, largely because it tended to become an industry which many emerging nations perceived as evidence of industrialization. And we created a very substantial amount of capacity, some of it quite obsolete and some of it extraordinarily high cost. And as you know, Secretary O'Neill, who was involved in endeavoring to, as a private citizen, bring down excess aluminum reduction plant capacity over the years, is trying to obtain similar sorts of adjustments in world steel capacity. And I would say that it's important that he succeed, or that, I should put it more generally, that he and his colleagues who are involved in these discussions make significant headway, because it's important to rationalize the industry.
But overall, you think that the overcapacity problem in the world is not going to dampen our recovery from the recession?
I think not. I think that it always does, but not to a greater extent. A more relevant concern is obviously the communications capacity problem, where a goodly part of high-tech investment is being impeded to an endeavor to absorb a good deal of the excess which has been put in place, but that will impede the recovery some, but not over the longer run. We managed to move capital from obsolescent, overcapacitated industries into cutting-edge uses quite effectively.
Thank you. Mr. Chairman, I recognize that my time is up. I would like to pursue with Chairman Greenspan the issue of data sharing and the quality of economic statistics. Maybe we can have that dialogue in another venue, but I know that he's a leader in trying to get good economic information, and I have an interest in information sharing, and we'll pursue that at another time when we don't have the time constraints.
Thank you, Senator Bennett. Mr. Chairman, we'd like to thank you and your staff for being here with us today. We appreciate it very much. We appreciate your message also that the foundation seems to have been set for an economic recovery, and that there are still, however, continuing concerns that we need to watch very carefully in terms of a number of factors that may play as a drag on economic performance. So thank you for being with us. We appreciate it again, and we look forward to seeing you again in the future. Thank you.
Thank you very much, Mr. Chairman.
The hearing is adjourned.